The last time banks did this, the economy flipped. It happened in 2000, in 2008, and what is beginning to happen in 2025 looks very much like it's heading in the same direction. You don't need to be an economist to notice it. When it becomes harder to get a loan, when your credit card limit is reduced, or they ask you for more paperwork for the same things as always, it means the credit faucet is closing. And when credit tightens, spending slows down too. The first place where this is noticeable is in credit cards, because they are what we all use every day. In the second quarter of 2025, a significant percentage of banks reported extremely stricter standards for credit card lending. This means that even if your salary and credit history are the same, now the bank makes it harder for you. They ask for more proof, require a higher credit score, or directly offer you less available credit. And not only that, the same report clarifies that banks reported that standards are currently at the strictest level for all categories of loans. In simple terms, it is harder to get credit now than at almost any other time since this has been measured. And when easy credit disappears, people buy less. If suddenly you can't finance a new TV, a car, or even day-to-day expenses, your consumption drops. And what you stop spending is what someone else stops earning. That's the gear that keeps the economy going. And that is where it begins to grind out, of course. The slowdown doesn't stop with credit cards. It also affects companies. Here comes the bridge. If you spend less, the store that sells to you also earns less. And if that store wants to take out a loan to survive or expand, it also has a harder time. These kinds of loans are the fuel that allows companies to hire more people, open new locations, or buy machinery. If credit tightens, companies think twice before taking risks. And if they don't take risks, they don't hire. That is how a quiet adjustment in lending standards ends up hitting employment hard months later. What's interesting is that this is not something that happened overnight. The tightening had already been building up before. Forbes stated that in January 2025, 12.5% of banks reported tightening credit standards for commercial and industrial loans to large and medium-sized companies, compared to 4.8% in the previous quarter. That was a warning mainly to businesses, telling them, get ready, because borrowing money is going to get more difficult. And now we are seeing it. It's curious because while the Federal Reserve talked about lowering rates, in practice the banks were doing exactly the opposite, closing access. One foot on the accelerator, the other on the brake. Up to this point, we have talked about the supply of credit, but we cannot forget the other side, household debt, because it's not just about money being harder to borrow. It's also about the fact that we already owe a lot. Household debt reached $18.39 trillion in the second quarter of 2025. That total represents a quarterly increase of $185 billion, equivalent to 1%. These are enormous figures. And when debt keeps growing while lending conditions tighten, the tension increases. It's like having your credit card maxed out while at the same time the bank tells you that you can't raise your limit. The feeling of suffocation increases. The best example of this tension can be seen in student loans. In student loans, serious delinquency, more than 90 days late, reached 10.2% in the second quarter of 2025. The fact that 1 out of every $10 of student loan debt is more than 3 months overdue means that many young people are drowning financially. And banks, when they see those figures, act cautiously. If delinquency rises, they tighten credit even more. That's the vicious cycle. When people stop paying, banks perceive more risk. When they perceive more risk, they restrict credit. And with less credit, even more people fall behind on payments. That if we put all these pieces together, it becomes clear why consumer credit is showing signs of a slowdown. In the same quarter, overall consumer credit grew only 2.3% annualized, while credit card lines grew just 0.7%. That is a weak pace for the United States, where private consumption drives 2/3 of the economy. When the growth of credit slows, households are forced to tighten their belts. And if they spend less, businesses sell less, and the economic cycle loses strength. And if we add costs to that slowdown, things become even clearer. In May 2025, the average interest rate on credit cards for all accounts was 21.16%. More than 20% interest means that financing with a credit card is almost a luxury. Even if you have approved credit, using it becomes extremely expensive. This makes even people who could continue spending decide to slow down. The Fed may talk about reducing benchmark rates, But in real life, what matters is the interest the bank charges you. And that is still sky high. It's worth pausing for a moment to understand how that shift in expectations worked. During the boom, people were convinced that housing prices could only keep going up. That belief justified taking on more debt, applying for additional loans, refinancing mortgages, and continuing to buy. But when prices stopped rising, that expectation broke. What was previously perceived as wealth turned into vulnerability, and the wheel turned in the opposite direction with the same intensity. Looking back isn't some boring history lesson. It's the key to understanding what happens when credit opens too much and then gets cut abruptly. It helps us understand the nature of credit cycles. It's not the same when the economy grows because there is more innovation, better jobs, or higher productivity, as when it grows because banks open the credit faucet. In the first case, growth is more sustainable. In the second, it depends on the faucet never closing. And as we know, sooner or later, banks always close it. The lesson this episode leaves us is that credit doesn't just finance consumption or investment, it also shapes expectations. When people feel they can borrow money without any problem, they act with more confidence, take on more debt, and push prices up. But when they sense that credit is tightening, confidence evaporates, spending slows, and prices fall. That duality makes credit both an accelerator and a brake at the same time. Now let's think about what is happening in 2025 that we're not saying we are going to repeat a collapse identical to 2008. Today, the financial system is more regulated, banks have stronger capital buffers, and the Fed monitors with greater rigor. But the basic mechanism hasn't changed. What determines whether the economy accelerates or slows down is not just the official interest rate. It's whether credit really flows. And when banks tighten conditions, even if the benchmark rate falls, people on the street still feel it as a brake. In the 2000s, we saw that a huge part of price increases came from easy credit, and then we saw a 30% crash when that credit was cut. That shows us just how much credit drives the direction of the economy. It's the difference between a boom that feels infinite and an adjustment that leaves scars for years. The moral is simple. Credit cycles amplify the ups and downs of the economy. When credit flows, everything rises faster. When it stops, everything falls harder. That was the lesson from the last time it happened, and it's the warning of what could happen again if the current moment is misread. What we've seen so far helps us understand where we stand. In 2025, there are signals pointing in two opposite directions: banks tightening credit and a Federal Reserve suggesting it might ease off the accelerator on rates. The result is a confusing scenario. We feel the brake at home, while the speeches talk about stimulus. Let's look directly at the words of the Fed's own chairman. In August, at Jackson Hole, he hinted that the course could change. The speech noted that the baseline outlook and the shift in the balance of risks could justify an adjustment in the stance of monetary policy. Translated into plain language, Powell said that if the risks require it, they will cut rates sooner than expected. That means the Fed is thinking about lowering interest rates in September, which would make it cheaper to borrow money and refinance debt. The idea is that if the economy begins to weaken and the labor market shows strain, it will be necessary to ease conditions with lower rates. Here comes the paradox. Even if the benchmark rate falls, what really matters is whether credit actually flows. And right now, banks are not in a generous mood. We can see this clearly in another key area: mortgage costs. Right now, the 30-year fixed mortgage rate is at 6.5%, and the 15-year rate is at 5.6%. Those numbers mark the pulse of the housing market. They may be lower than a year ago, but they are still expensive for many families. And if banks tighten their requirements on top of that, it doesn't matter much if the official rate drops. What people feel is that buying a home is still difficult, and this, in turn, affects employment. When the housing market cools, construction slows down, spending linked to that sector falls, and overall hiring weakens. And that is already being reflected in the job numbers. In July 2025, the unemployment rate was 4.2%. That number by itself is not alarming, but what is worrying is the trend. Unemployment has been rising compared to recent lows, and not only that. In the same month, the number of long-term unemployed reached 1.8 million people. This means not only are there more people without jobs, but more people are trapped in unemployment for months. That is the hardest part of the cycle, because the longer someone is out of work, the harder it is to return to the labor market. And as that group grows, consumption weakens even more. This brings us to the state of job vacancies. If banks tighten and companies perceive more risk, they hire more cautiously. In July 2025, job openings were 7.2 million, while hiring stayed at 5.3 million. That gap shows that the labor market is losing momentum. Vacancies are falling, hirings are stagnating. Same message: less credit, less investment, less employment. And the longer this pattern lasts, the more the economy engine cools. Now let's look at the price side of the story. The Fed wants to cut rates because inflation seems more contained. In July 2025, the Core Consumer Price Index, which excludes food and energy because those prices fluctuate a lot, rose 3.1% year over year. That level is lower than in 2022 or 2023, and it gives the Fed room to consider rate cuts. But here is the paradox again. Even if inflation falls and the Fed cuts rates, if banks don't lend more, families and companies won't feel it, and the economy will stay weak. This is the dilemma of 2025 and 2026. What will dominate? The Fed with its foot on the accelerator, or the banks with their foot on the brake? We have two possible scenarios. Scenario 1. The banks dominate that if they don't lend, consumption falls, companies hire less, and unemployment rises. In that path, the Fed can cut rates, but the effect will be limited because the key that opens credit is not only held by the Fed, it's held by banks. Scenario 2. The Fed dominates if it cuts rates and markets react well. The interest paid by families and companies drops, giving them breathing room to spend or invest a little more. But even in that case, if banks remain cautious, the recovery will be weak and slow. So, what can we do at a personal level? Here we are not talking about magic formulas, but about mindset and preparation. The first thing is to increase financial education. The idea is that when you understand what data to look at and what signals to follow, you can stay ahead of the crowd. The second step is to build your own investment system. That means stopping the chase for promises of easy passive income. The third key is anti-cyclical mentality. When credit expands, don't fall into the temptation of over-indebtedness. And when it contracts, don't panic. Evaluate where there are real opportunities. Those who manage to navigate these cycles calmly usually come out stronger. Investing always carries risks, but with preparation and method, you can detect signals earlier than others and move better in a changing credit environment. Credit can be an accelerator or a brake, and the difference lies in how we read it and how we prepare. And there is something else we must not lose sight of. These scenarios are not static. The market changes every quarter, banks adjust their policies, and the Fed reacts to data. That means that, as investors or simply as citizens, it's not enough to understand the current picture. You must follow the movie in real time. Those who understand where credit is turning before others will have an advantage to protect themselves or seize opportunities. That is the essence of moving intelligently in such an uncertain cycle.